Is inflation eating your lunch? Well, it's certainly taking a big bite out of it, and it's not just your lunch that's feeling the heat. Over the last year, record high inflation driven by the pandemic, geopolitical tensions, soaring energy prices and supply chain disruptions has impacted nearly every aspect of our monthly spend. The price of housing, utilities, energy, basic food items, dining out, clothing and footwear have all risen significantly, even as central banks around the world have raised rates and global growth has slipped. Unfortunately, one of the things that's remained more or less the same over the past year is our wages. The modest increase in payrolls has not kept up with runaway inflation, leaving us with reduced spending power and in many cases eroding our savings. And what makes this even more daunting is the prospect of long-term structural inflation. While the recent run of high inflation is expected to eventually abate, inflation over the longer term will likely remain elevated because of structural shifts such as green transition, deglobalization, infrastructure upgrades, and demographic changes that are already underway. These trends could continue to erode the purchasing power and savings of individuals unless they focus on a real return approach which can truly safeguard their investments. However, in this ever-changing market environment, there is no one-size-fits-all investment approach, and certainly no single asset class that can outperform in all of the various investment cycles. Asset classes which tend to perform well in inflationary environments will likely perform very differently in growth and slowdown cycles. From an investor's point of view, the challenge is to generate positive returns from their investments while mitigating risk from shifting volatility in various economic and business cycles. The question is, how do investors know what to invest in and when?
We study and analyze macro trends and look for market signals to determine which economic regime we're in. Our investment team will then adjust the asset allocation based on the expected macroeconomic scenario using our flexible and active approach. Each regime has different asset allocation strategy. So the strategy will aim to maximize growth potential in the growth period, enhance returns in the inflationary cycle, turn defensive during a slowdown, and mitigate drawdown while in a stagflationary environment.
Also, in this strategy, we target to achieve real returns by exceeding the US inflation rate, and we aim to do this by investing in a diverse range of assets, with a strong focus on real assets. This asset class has intrinsic value due to their substance and physical properties, and often work as a hedge against inflation. They have a relative low correlation with other financial assets, such as stocks and bonds. Historically, real assets have performed better when compared with other asset classes in an inflationary cycle because of their price appreciation during the inflationary period and their inflation-linked earnings prospects. At the same time, we invest in liquid real assets, such as inflation-linked bonds and property stocks, to ensure that our portfolio can react to rapidly changing market cycles in a timely and effective manner.
At HSBC Asset Management, our large footprint and established track record allows us to effectively diversify portfolios and invest with purpose and discipline, so we can help our clients meet their investment goals and aim to prevent inflation from eating into their financial futures.